when we think about broad active risks, we try to focus on three key pillars of those active risks. First is around structural inefficiencies in fixed income markets. Our view is that in fixed income markets, because of prevalence of balance sheet constraints, regulatory constraints, liquidity constraints, dependence upon rating agencies, as well as presence of non-economic buyers like passive investors, creates a lot of structural inefficiencies that we as active managers can take advantage of. Next pillar for us is around thematic active views. This is where all of our active research at the top down from macro point of view, policy point of view, as well as fundamental credit research comes into play. And then finally, the third pillar for us is around opportunistic investing. This is where we just have to be a little bit patient. We have to wait for the market to come to us, and you don't see as many dislocations at any time. But generally, you tend to see overshoots during periods introduced by geopolitics or liquidity events. There are plenty of areas that we see opportunities for active adjustment in the portfolio to take advantage of many of the dislocations. In the corporate credit space, what we have seen is that liquidity premium has come down. What we have done in the portfolio is reduce our allocation to credit, replace it with higher quality spread products like agency mortgages, like structured products, and that limits the downside in the portfolio during periods of volatility. More recently, what we have seen is a pretty significant repricing in the US interest rates. Following that repricing, we have meaningfully increased the duration risk in the portfolio. We have gone from about half a year underweight 6 months ago to now almost 0.75 years overweight on the duration space. The global relative value continues to play an important role. We like sovereign bonds in Canada, in UK, in Australia. Inflation as well as deficits continue to get reflected through tips in the portfolio. One of our macro themes is uncertainty is certain. In this particular environment, uncertainty levels will be high. I think there will be volatility, there will be dislocations. What we have done is increase the dry powder in the portfolio to take advantage of those opportunities. I think the net of it is that the reason for why we think fixed income is so attractive stems from higher yield, stems from the diversification benefit, and stems from the reason that the relative value versus cash as well as equities looks quite attractive.